Good day, class. We are discussing about bonds. So, bonds are financial instrument that represents loan made by the investor to a certain borrower, usually corporation or a government. So, when you purchase a bond, you're essentially lending money to the issuer. Issuer is like a company or a government in exchange for periodic interest payments in return for the bond's face value when it matures. So bonds are popular in investment, no, and because they can provide steady income and are generally considered safer than stocks. So uh, usually they say that the bonds is the backbone of the investments, no. So these are debt securities to represent loan by the investor or a borrower. So typically those uh uh, money borrowed uh, from the investor, usually they play a crucial role in there's diversification in investment portfolios in order for to provide stability and regular income and potential capital appreciation along the way. So you in these bonds you will always hear about diversification, no? So, and also you have the different types of bonds. So you have the government bonds, you have the corporate bonds, you have the municipal bonds. So government bonds usually by the national government, no? So typically they are the bonds considered for the safest type of bond investment because it has a low risk of default. Because government, of course, government has a uh, stable output, no? So they are a low risk uh, other than the other bonds. No? So for corporate bonds, of course, corporate. So these are issued by the companies. So these bonds are uh, higher yields. But of course, when you have higher yields, it has more credit risk than the government bonds. So if you are aggressive investor, you go with corporate bonds. So the last type is a municipal bonds or by the government or by the local government. So these bonds provides tax to fund exempt in income, and usually these are used in public projects. So these are the type of bonds. Okay. So for bond pricing, so we have the par value, coupon rate, market price. So for par value, it means a face value or the face value of the bond. So which is the amount of the issuer that promises to repay at maturity date. Okay. So coupon rate is the interest that the bond issuers pays to the bondholder. Typically, they are paid semi-annually. Okay. So for the market price, it is the current price at which a bond trades, which fluctuates it based on various factors. Okay. So for the yield to maturity, when you say yield to maturity, it is the total return an investor will receive if a bond is held until its maturity date. So it taking into account the bond's price, the coupon rate, and the time of the maturity. So the importance of yield to maturity is it is the key metric in evaluating and of course comparing the different bond investment that you are putting into. And also the factors when you in yield to maturity is that uh, it is influenced by factors such as interest rates, inflation, and the bond's credit quality. So that is a factor in yield to maturity. So in having interest rate risk, you have the interest rate increase, the interest rate decrease, and then the duration. So when you say interest rate increase, it is when the interest rate rises uh, when the market value of the existing bond decreases. So as newer bonds with higher yields become more attractive, so the interest rate increases. when you say interest rate decreases, it is when the interest rates fall. So the market value of the existing bonds increases. So as their fixed rate coupons become more valuable, so the interest rate decreases. And then the duration. So when you say the duration, this is the sensitivity of bonds price to changes in interest rates, which is measured by its duration. So which is a key factor in managing interest rate risk. And when you say credit risk, you have is it safe or is it not safe? So in order for you to know the credit risk when you are going into, is you have the factors of the credit rating, the investment grade, and the junk bonds. So when you say credit risk, when you say credit rating, um, usually these are the bonds that are assigned credit ratings by the agencies. So which reflects the issuer's credit worthiness and likelihood of default, no? So when you said investment grade, usually these are the high quality bonds with low credit risk. So typically rated triple B or higher than the or higher by the rating agencies. And the junk bonds, these are the bonds with higher credit risk. So these are typically rated below the investment grade, offering higher yields to compensate for the added risk. So these are the junk bonds. So these are the uh, under the credit risk. Okay, so this is diversification of with the bonds. So in diversifying with the bonds, you are able to have a stability, diversification, and risk management. If you are diversifying with bonds, of course, if it's stability, those bonds can provide stability and income to your portfolio, it offsetting the volatility of the stocks. When you do the diversification, it has a bonds with different maturities, issuers, and credit qualities. They can help you to diversify your portfolio's risk. It lessens the risk of your portfolio. No? And risk management, the bonds can be used uh, to manage overall portfolio risk, and it also aligns the investments with an investor's risk tolerance. No? So, so the risk, the portfolio bonds, no? So, the role of bonds in portfolio is that it gives you an income generation, it gives you a capital preservation and diversification. So, bonds can give you income generation in a sense that they can provide you a steady stream of interest payments, no, making them attractive for investors uh seeking for regular income. So this is a good investment, no, for a bond if you want income generation. So capital preservation, these are generally considered uh, uh less risky than stocks, no, making them suitable for investors to who prioritize capital preservation. So lastly is the diversification. Of course, it helps you to diversify a portfolio, reducing overall risk, and it provides a counterbalance to the volatility of other classes, no. So also in I just wanted to add also that some of the key points uh in bonds that issuer. So when you say issuer, these are the bonds can be issued by various entities, no? So like what we've discussed in the first slides. These are usually corporation, municipalities, and government. So maturity, when you say maturity, these are the bonds that have set maturity date at which the point the bond issuer repays the principal or the whole investment to the bondholder. So maturities can be varied from short term to long term. So short term, few months to few years, to long term or to meaning decades. No, so interest rate or the coupon rate. So these are the bonds pay interest to bondholders, typically semi-annually, like what I told you. So bond prices, ito yung these are the bonds often traded to open market. So their prices can fluctuate. So if interest rates rises, the existing bonds may lose value, and if interest rates fall, existing bonds may gain value. So bonds can be a good way to diversify your portfolio, and it balances the risk as they tend to be less volatile than stocks. So different types of bonds, and yeah, we have the government, municipal, and corporate. So we have unique benefits and risk in investing bonds. So these are bond value equations. These are the formula in getting the face value. F represents the value of the bond or the face value of the bond. So A is the periodic payment or the dividend of the bond. So I represents the rate of the investment. C is the redemption price. R is the divided rate of bond. So we these are the formulas to be used in bonds. Okay. So we solve a few problems. So the first one, a company issued 50 bonds of $1 million dollars face value each. So the redeemable at par at the end of 15 years to accumulate the funds uh, required for redemption. So the firm established a sinking fund consisting of annual deposits. So the interest rate of fund being 4%, what was the principal in the fund at the end of the 12th year? So solution, we have our, of course, our formula that that was given. So is F is equals to A quantity 1 plus I raised to N minus 1 all over I. So we have the value, no? We have 50 bonds. So we have 50 bonds of 1 million, no? Then you have the annual. Then 1 plus 0.04 raised to 15 because it's 15 years now. So minus 1 over 0.04. So you compute for your annual. Then the answer would be around 2,497. Sorry, it's 1,000 pesos only. Sorry, $1,000 only. Sorry, $1,000. So $1,000. So that would be 2,497. Okay, then they said we want, what was the principal in the 12th year? So F12 would be F12 is equals to A, which is $2,497 multiplied by 1 plus 0.04, 12 years. No? So minus 1 over 0.04. So the answer would be 37,509. Okay. So next, a local firm is establishing sinking fund for the purpose of accumulating a sufficient capital to retire its outstanding bonds at maturity. So the bonds are redeemable in 10 years, and their maturity value is 150,000 pesos. So how much should be deposited each year if the fund pays interest at the rate of 3%? So we will use, of course, our formula. So we have F is equals to A quantity 1 plus I raised to N minus 1 all over I. So we have the face value, which is 150,000 equals to, we are looking for A. Then we have 1 plus I, or 3% raised to N, which is 10, no? Minus 1 all over 0.03. So you calculate it, so I think we can have 13,084.58. Okay. So next problem. So to secure a return of 4%, at what price should a bond be purchased if it is redeemable at 1,000 pesos in 10 years and pays annual dividends 35 pesos? So we have this Vn is equals to C all over 1 plus I raised to N plus FR 1 plus I raised to N minus 1. So this one all over 1 plus I raised to N 1. Right. So we have N. So you have 35, the annual dividend. So you have 35 quantity 1.04 raised to 10 minus 1 all over 1.04 raised to 10 multiplied by 0.04. Then plus 1,000 all over 1.04 raised to 10. Then the Vn would be equals to 959.45 purchase price. So these are some of the problems. So you can also have a practice problem. So you can check this out. So the practice problem, you have an investor was offered a land bank certificate with a face value of 350,000 pesos, which is bearing interest of 8% per year, payable semi-annually and due in 8 years. If he wants to earn 5% semi-annually, how much must he pay the certificate? And then the other practice problem is a $2 million issue of 3%. 15 years bond was sold uh, at 95% if miscellaneous initial expenses of the financing were $25,000 and yearly expenses of $3,000 is incurred. What is the true cost to the company is paying for the money? So, uh, any question you can ask me in the group. So, thank you.